For Insight, we're joined by LeBas. He's Chief Fixed Income Strategist for Janney Montgomery Scott. He's rated a Bloomberg Best. Welcome back to In Business. So it looks like the stock market and the metals market said more money's coming our way. That's a good thing. Bond market a little bit more apprehensive. What's your bottom line from the Bernanke announcement?
Well, I think this really shows the Fed's policy of what I would describe as stimulus at pretty much any cost. And I think the extension of this sort of low rate pledge is a little bit of deja vu over what we had over the summer. Essentially, the Fed is fueling cash to be able to go into risk assets. And risk assets includes things like corporate bonds, it includes metals that you mentioned, and it also includes U.S. stocks. So it's very supportive of those markets. However, the bond market seems to be a little bit more skeptical, particularly when you look out 10 to 30 years, about the potential inflation risks of a policy such as this.
So what are your target areas for the 10 and the 2-year? I know your forecast on the 2-year makes you one of the Bloomberg Bests in terms of accuracy.
Well, the 2-year note is really anchored by the Fed. I mean, it's weighed down by this huge anchor. Actually, in fact, the 3-year note has the same effect. So we don't really see 2 or even 3-year interest rates rising over the course of the next year or so. But when we look longer out the curve, I think the market's going to be a little bit more sensitive to the prospect of QE3. And kind of one of the Fed's dirty little secrets is, even when they engage in bond buying programs, they're secretly trying to raise long-term interest rates, because that would imply higher inflation expectations. That would imply that they're doing the right thing. So if the Fed does enter into QE3, we could actually see longer-term rates out beyond 10 years or so increase a little bit. And I think that would be a good sign the Fed is doing its job and working successfully to sort of push through this economic malaise.
So what's the danger of that?
Well, I think the danger of that is essentially, the Fed doesn't take the punch bowl away soon enough. Right. And to this point, inflation risk has been very, very benign, and we don't see evidence of core inflation, but the crystal ball gets extraordinarily cloudy once we look out to 2014, 2015. So it's possible, although unlikely, that the Fed policies right now could be risking inflation 5-10 years into the future.
5-10 years into the future, but that targeting right now is not going to help control that?
Well, no. I mean, the Fed has sort of this trade-off between transparency and flexibility. And what Bernanke has chosen several times over the course of the last couple of years or so, he prefers transparency. So he, and is willing to lead the Fed in this manner, is really sort of giving up the Fed's ability to adjust policy more quickly in exchange for showing the markets, hey, here's what we're going to do for sure, or at least close to for sure.
What's your read on the new home sales report we got this morning?
Yeah, there's been a lot of optimism slowly building about the new new home sales market. I think we still see some really positive underlying trends going on there, which is to say that the degree of supply behind this level of sales is improving. And so we're really taking a look at that ratio of supply to demand. As a positive sign, the new housing markets are stabilizing. Not going to take off anytime soon, but at least stability.
2.2% drop as a sign of stabilization?
We read the fact that inventories have now been coming down for nearly 6 months straight in the new home sales report as a sign of stabilization. I think we're going to see better sales rates when we get into the spring of 2012.
All right. A lot of people can't wait for that. Spring of 2012 is your forecast, Guy. Thank you very much.